Hello and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching. And China has accused the US of stoking panic over its rare earth controls and rejected a White House call to roll back the curbs. This after US negotiators suggested China could avert President Trump's threat to impose 100% tariffs on Chinese goods by scrapping the measures set to take effect on November 8th. Federal Reserve Governor Christopher Wallace says he supports another rate cut because of the mixed readings on jobs, saying that based on all the data they have on the labour market, he believes that the Fed should reduce the policy rate by another 25 basis points at their meeting that concludes on the 29th of October. The US two-year Treasury yield fell to 3.4%, the 10-year down below 4%, and markets pricing in a 95% chance the Fed funds rate will be cut by 25 basis points at the next policy meeting at the end of the month. There's around 5 more cuts, according to money markets, in total in this easing cycle. The US dollar fell on the Wall Street session. At the moment, we are seeing weakness, though, still coming through in the Aussie, which has fallen below 65 US cents. Let's get across the technicals now. Ilya Spivak joins me from Tasty Live. Always great to see you, Ilya. We did see the Nasdaq retreat by around 0.5%, but still holding above 22,000. What are the charts showing you?
Always a pleasure, Juliet. And there's a very interesting setup here happening in the Nasdaq. Most interestingly, it's of course showing up in most U.S. stocks, but in the Nasdaq in particular. And what's striking about this is, of course, on Friday last week, we had that brutal sell-off, and we've been trying to come back this week, and every single time that we test this 25,000 level, we're met with stiff resistance. It is as though there is a wall there. And we've tried it now over several days in a row. What's interesting is that the trade war headlines haven't really become worse. They haven't really become better either, but they haven't gone in a more adverse direction. Moreover, Scott Besant is out here saying Trump and Xi are going to meet, it's going to be okay. The president saying it's going to be okay. USTR Jamison Greer saying the same thing. So ostensibly things have not become more negative, but markets can't seem to shrug off like they have been similar stories between, let's call it, April and this most recent top. The indication being that perhaps there is a more serious risk-off contingent happening here. It's, of course, very telling that of all the things to be most hurt by the trade war, it's the Nasdaq, which you wouldn't think is that sensitive. What seems to be happening is people are selling that which has been the most speculatively outperforming. And that hints that maybe the markets are in some sort of a regime change here.
Absolutely. Now, of course, when it comes as well to interest rate outcomes and what the RBA is going to do versus the Fed, this is all weighing on our dollar, which is falling against the greenback.
Well, that's right. So one of the most interesting aspects of this sell-off, of course, the dollar has weakened a little bit against things like the euro, for example, or the pound or the yen. But the Aussie has been beat up with stock markets here. It's taking up that sort of risk-on role that it often does in FX markets. And that, again, seems to give you the sense that there is not just a soggy U.S. stock market here, but a broader market shift into risk-off mode. If, in fact, all of this negativity facing the U.S. and all of the follow-on from it for the dollar were the dominant driver, of course, the outlook for the RBA hasn't gotten any more dovish through these several days, then you'd expect the Aussie to perform as well as, say, the euro or the pound have. But instead, we're in this increasingly binary risk-on, risk-off world where chasing yields is not the priority, protecting capital is. And that seems to be weighing on the Aussie here. Certainly that China is involved doesn't help, but it continues to add evidence and give credence to this idea that the markets have fundamentally changed into risk-off mode as the default.
Absolutely. All right, let's get into the bond market, because as we do look towards the end of the month and that expected cutting, bonds continued here to move higher.
That's right. And this sort of ties it all together. So we have stocks going down. We have the likes of the Aussie underperforming, though we have what we have on this chart here, which is U.S. yields falling. And this, of course, lines up with bonds rising and winds up with building Fed rate cut expectations. When we look at what's on the menu today, Fed funds futures are now entertaining the idea that we're going to get a 50 basis point rate cut either at this next meeting coming up at the end of October or at the one in the first half of December. In fact, strikingly, the likelihood that one of these meetings will give us a 50 basis point rate cut is now close to 20%. That's quite high. In fact, the markets are even entertaining the slight possibility, though it is very small at this point, that we might get a 50 basis point cut at both of these meetings. And that's very clearly a dovish shift in the market's thinking. Certainly the comments from Chris Waller earlier today moving us in that direction. What's striking is that this is exactly the kind of thing that would have been incredible fodder for sentiment only a few weeks ago. Stock markets were loving bad economic data. They were loving anything that meant more rate cuts. And pointedly, that is no longer the case. Bonds are rallying and stocks are falling. This is a much more classic risk-off dynamic. Again, signaling maybe whatever we know from the early April lows in sentiment until just these most recent highs may now be on its head.
Yeah, indeed. All right, Ilya, really appreciate it. Have a great weekend when you get there. Ilya Spivak from Tasty Live with us. That does it for this edition of The Trade. Be sure to join us on Monday.